Raise or sell? What should you do now? Sound familiar? A traditional VC raise means you bring new capital into the company for further growth, but you won't be able to sell right away as any new round of funding is coming in at a higher price. New investors, often with liquidation privileges, expect a higher multiple to their investment. Thus, you must grow the company appreciably before selling, usually years. There's actually a way you can raise and explore a sale at the same time. That's the recapitalization option. This is due to trillions, not billions, available for investment by private equity buyers. Let's better understand what recapitalizing the company means. Recapitalization is where a company restructures its capital, often by bringing in outside investors, such as private equity firms, and shifting the ownership mix between debt and equity. This doesn't necessarily mean a full sale. Many times, owners stay on board and retain a significant stake, a minority or majority position. Whether it's to fuel growth, take some money off the table, or bring in a strategic partner, recapitalization can be a powerful tool for CEOs looking to evolve without giving up control. Let's explore some reasons to consider a recapitalization. One of the most common reasons is to secure capital to scale. This could mean expanding into new markets, developing new products, or making acquisitions. The company might be profitable, but not have enough cash on hand to pursue big opportunities. A recap brings in money from a new investor to fund this next phase. Many founders are all in financially. Their personal wealth is tied up in the company. Recapitalization allows them to partially cash out, gaining liquidity while still holding equity and staying involved. This is often referred to as the first bite of the apple, with the opportunity for a second bite when the company sells later at a higher valuation. Private equity or growth equity investors can do more than just write a check. They bring operational expertise, connections, marketing and sales know-how, and access to new customers or verticals. This type of recap is about accelerating performance, not just changing ownership. In companies with multiple founders, sometimes not everyone is aligned. Recapitalization can be a solution when some want to exit and others want to double down and keep growing. It enables a clean exit for retiring shareholders, while empowering others to push forward with a growth partner. Some recapitalizations are done to pay off debt or restructure the company's financial foundation, especially if there's been uneven growth or a period of stagnation. PE firms often help optimize operations, cut unnecessary costs, and refocus the business. Let's look at two examples of recent Corum clients that leveraged a recapitalization to achieve an optimum outcome. Two young founders in their early 40s with a $5.5 million software company. The company had excellent future potential and wanted to test the waters. They entered the market. The response was overwhelming. 30 NDAs and 5 letters of intent from strategic buyers and a private equity firm. Corum and the seller decided to set aside strategic buyers and focus on the private equity firm, strategizing that this would be the route to maximize valuation and structuring a deal that would give the founders a second bite of the apple. Ultimately, Corum helped them negotiate a majority recapitalization of 60%, giving the founders a significant liquidity event at a £15 million valuation. Each founder owned 50% of the company. One took their share in cash and exited the company. The other founder took half cash and the other half in rolled equity, meaning they kept stock in the remaining company, wanting to stay on and be part of the growth opportunity. The founders were thrilled to find an investment partner to help the company realize growth ambitions, expand capabilities, invest in the team, and fund future acquisitions, all while positioning for a second, potentially larger liquidity event down the road. Within 6 months, the company made its first acquisition, growing its business offerings. And just 14 months post-transaction, they made their second acquisition. The company has won multiple industry awards for innovation, and its happy ending just keeps getting better. Now our second example. A software company with multiple founders. They'd plateaued, unable to grow from $5 million to $10 million organically. 2 of the founders also wanted to retire and exit the business. Buyer interest was strong. including interest from several private equity firms with active investment thesis in the particular segment. The result? A $28 million EV deal with structure that enabled the founders to take some chips off the table and roll 40% of the deal proceeds back into the new company. Transaction total $28 million EV, $21 million cash at close, $5 million seller note, $2 million in performance-based earnout for the balance of the calendar year. The transaction also added investment onto the balance sheet to allow the seller to build out their go-to-market and establish a new indirect channel to accelerate organic growth in its North American and European markets. The deal has resulted in a portion of the founding team staying on and continuing to expand and grow the business with a savvy PE providing operational know-how. Additionally, 2 of the founders were able to retire and retain rolled equity in the new business. The classic PE model of buy-build for 5 years and then exit will provide the opportunity for a second material wealth creation event for the founding team. How are they doing? Within 12 months of the transaction, they made their first acquisition, well on their way to realizing some of their goals. Recapitalization is not just about raising money. It can be the mechanism to align with the right partner, de-risk, accelerate, and position the company for greater success. But you need an advisor who knows the private equity firms that do recapitalizations. The Corum process will help you find your optimum outcome, the one best suited to meet your and your shareholders' needs. Whether it comes from a recapitalization, a sale, or a merger, your value will improve markedly, an average of 48% from first offer to last, going out to both strategic and financial buyers in a true global M&A partner search process.